Okay, this is Richard Patrick here again, Oakland, California mortgage broker. Uh, Basically what we're going to cover today in this video is about refinancing, consolidating to get cash out, to turbocharge your retirement, to resurrect your retirement. If it's dead, turn your 201k back into a 401k, and to save your investment portfolio from professional gambling. Many people we encounter are trying to get ahead financially, but what they really don't realize is that they're basically driving down. It's like driving down the highway with their foot on the brake and their foot on the gas at the same time. They're saddled by debt. Most people don't have a financial advisor, um, and the majority of America's, they're either underemployed or they're saddled with debt. And that's one of the things we want to help our clients avoid, as you can see here on the screen. So there are, believe it or not, there are quite a few families that we encounter that still have equity and credit, um, and that need, instead of buying depreciating goods, depreciating assets, really need to start putting that money away. And that means changing your spending habits, coming up with a budget, and getting really serious about retirement, because you can't start saving or getting ready for retirement. If you need $500,000 or $1 million more, you can't start doing that at the last minute. You need to start as early as possible. So let's go ahead and get into this example to show you how we help the family get out of debt, get out of the rat race, and establish an emergency fund in case of financial disaster, and supplement their retirement. So we see there was, property value worth about the property's worth about 650. They had two existing loans, a first and a second, and then other considerable debt here: car payments, credit cards, installment loans, retirement account loans, and things of that nature, credit cards. And generally what we try and do is pay off the credit cards with the highest payments first to give you, more debt relief, and then work on the other payments over time. So that way you can become debt free in a shorter time than you thought possible. So what we were able to do is consolidate all of those debts, as you can see here, work on a new mortgage. You can see the difference here between the debts that are being paid off and the new mortgage is about $105,000. That covers closing costs. Okay, the immediate savings would be about $1,700 a month. We took $1,000 of that and started putting it away in the side fund, along with the other $100,000. Okay, that's in a safe, secure fund. So the other $700 was going to go to pay off these debts over time. So now these debts will be paid off in no more than 2 years and 3 months. Right around 2 years is when all these debts will be paid, and that will free up an additional $700 a month. So now we're looking at $2,400 to $2,500 a month in savings, or $30,000 a year, in addition to $100,000 in cash. So now that you're getting rid of all this negative debt or bad debt, you can become your own bank, essentially. And here's what I mean by that. Instead of paying, reducing the term, why not pay yourself and put the money in the bank, and then that way you can pay off the mortgage whenever you choose. In this case, they'd have enough money to pay off the mortgage in almost 13 years. Okay, as opposed to before, it was going to take 30 years just to pay off the mortgage, and then sometimes up to 14 years to get completely out of debt. So now, in less time than it would take to get completely out of debt, with the same monthly payments. Now keep in mind, this is paying the exact same thing that they're paying now on a regular basis, reallocating those dollars to become free in 13 years and save $160,000. Now, if you need advice like that, feel free to give us a call. Email us here or call 510-481-7500.